market top is one of the most fascinating and treacherous environments in the entire financial landscape. It is analogous to reaching the summit of a great mountain after a long and arduous climb. The air is thin, the views are breathtaking, and the feeling of euphoria among those who have made the journey is almost palpable. It is a moment of peak optimism, a time when the future seems limitless, and the possibility of a decline feels like a distant and irrelevant concern. But it is precisely here at this zenith of positive sentiment that the greatest danger lies. For the vast majority of market participants, the summit is the point of maximum financial risk, a place where fortunes built over months of careful climbing can be destroyed with catastrophic speed. But for Richard D. Wyckoff, a market top was not a place of peril to be feared. It was a laboratory to be studied. It was the unique environment where he could observe the actions of the great informed financial interests, what he termed the Composite Operator, in their purest and most revealing form. He understood that a top is not a singular random event. It is a process. It is a slow, deliberate, and meticulously engineered campaign conducted by the smartest money in the world to distribute their vast holdings to a willing and eager public. Through decades of tireless observation of the tape, Wyckoff identified a distinct sequence of events, a series of telltale symptoms that, when understood, serve as definitive proof that the market is preparing not for a new ascent, but for a long and punishing fall. This is the anatomy of that process. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't going well. The first definitive proof that a healthy, thriving uptrend is in jeopardy is the appearance of a fundamental change of character, which is then confirmed by a decisive stopping action. A healthy bull market has a distinct personality. Its character is one of effortless progress, of consistent and orderly advances. On a chart, this is reflected in price bars that have wide, healthy spreads that consistently close near their daily or weekly highs, and that show a clear upward trajectory with only minor and shallow reactions. There is an unmistakable ease of movement to the upside. The very first piece of evidence that this long-established and healthy condition is beginning to erode is a subtle but noticeable shift in this behavior. This change of character can manifest in several ways. The previously effortless upward progress may become labored and difficult. The price spreads, once wide and dynamic, may begin to narrow, indicating that each step higher requires a much greater struggle. The price bars, which once stood distinct and separate, may begin to overlap significantly, a clear sign that the market is no longer a one-sided affair, but has devolved into a two-sided battle between buyers and sellers. Volatility may also increase dramatically. The calm, orderly advance can give way to sharp, erratic swings in both directions, a symptom of the conflict between large professional interests who are beginning to sell and the still enthusiastic public who continue to buy. This change in the market's personality is the first symptom, the initial, often intuitive, warning that the underlying strength of the trend is beginning to wane. This subtle shift is soon followed by the first piece of concrete, undeniable evidence, the preliminary supply. This event marks the first time that a significant, concentrated block of institutional selling enters the market to check an advance. As the stock attempts to rally, it is met with a wave of selling that is far more powerful than anything seen previously in the trend. On the chart, this is often represented by a rally that occurs on a surge of trading volume, but which stalls and fails to make significant upward progress. The price may churn, struggling to move higher, and the bar will often close in the middle of its range or even near its low. This is the footprint of the composite operator. He has begun his campaign. He is using the public's enthusiasm and the momentum of the uptrend as an opportunity to begin feeding his large line of stock into the hands of willing buyers. The preliminary supply is the first definitive proof that a formidable and intelligent opposing force has entered the field. The culmination of this initial stopping action is the buying climax. This is the single most dramatic and revealing event in the formation of a market top. It is the apex of public euphoria, the point where all caution is thrown to the wind. The news surrounding the stock is invariably wonderful. Earnings reports are spectacular, analysts are issuing bold price targets, and the public, swept up in the speculative frenzy, is convinced that the stock is a can't-lose proposition. They buy with an abandon that borders on madness. The chart reflects this climax of emotion with a day or week of extraordinary activity. There is a surge to a new high on climactic, often record-breaking volume, and the price spread for the session is typically very wide. To the amateur, this looks like the ultimate confirmation of strength, a powerful breakout that signals an even greater advance to come. But the professional Wyckoff analyst sees the truth hidden within the action. He observes that despite the incredible volume and the sharp thrust to a new high, the price fails to hold its gains. The bar for the session closes not at its peak, but significantly lower, sometimes even in the bottom half of its range. This is the irrefutable proof. The tremendous, euphoric demand from the public was met, and ultimately overwhelmed by an even greater, invisible torrent of supply from the composite operator. He used the public's buying panic as the perfect cloak under which to distribute a massive tranche of his holdings at the best possible prices. The buying climax is the definitive proof that a great transfer of ownership has taken place, from the strong, informed hands of the professionals into the weak, emotional hands of the public. This event marks the successful completion of Phase A of distribution, and it is the first great pillar in the logical case for an impending market decline. The second definitive proof that a market top is in formation is the evidence that the market is now building the cause for a subsequent markdown. After the violent and emotional crescendo of the buying climax has successfully halted the uptrend, the market enters a new and entirely different phase. It transitions from a state of clear trend into a state of tenuous equilibrium, forming what is known as the trading range. This is Phase B of the distribution process. The amateur, seeing that the price is no longer falling, often mistakes this sideways action for a healthy consolidation, a simple pause before the next great leap upward. But in reality, this trading range is a theater of war. It is the arena where the composite operator conducts the bulk of his distribution campaign. This period of sideways action is the cause being meticulously constructed for the great effect, the long and sustained downtrend that is to follow. The primary objective of the composite operator during this phase is to sell the maximum possible number of shares at the highest possible average price, and to do so without causing a premature collapse in the price. To achieve this, he must engage in a masterful campaign of deception. He knows that the public is now conditioned to buy the dips. Therefore, whenever the price falls toward the lower boundary of the trading range, he will provide just enough support to stop the decline, creating the illusion that the stock remains fundamentally strong and that powerful buyers are still present. This encourages the public to continue buying on weakness. Then, as the price rallies back toward the upper boundary of the range on this manufactured optimism, he will meet this rally with a fresh wave of his own supply, selling into the public's buying and preventing the price from breaking out to a new high. This process of selling on rallies and supporting on dips creates the characteristic choppy back-and-forth price action that defines the trading range. It is an environment deliberately designed to be confusing and frustrating. It is during this phase that the composite operator performs the critical task of absorbing the market's remaining demand. Every share that a hopeful member of the public buys is a share that he is able to sell. The significance of time during this phase cannot be overstated. A quick, narrow trading range implies that only a small amount of distribution has occurred, and the subsequent decline may be shallow. However, a long, broad, and extensive trading range, one that lasts for many months, is proof that a massive cause is being built. It is evidence that the composite operator has an enormous line of stock to distribute, and that he is taking the necessary time to do so carefully. The longer this process continues, the more shares are transferred from strong hands to weak hands, and the more severe and sustained the subsequent decline is likely to be. The patience to sit and observe this entire process, to watch the evidence of supply appearing on each rally, and to resist the temptation to participate in the meaningless and treacherous swings within the range, is a hallmark of the professional speculator. He understands he is witnessing the painstaking construction of a great cause, and he waits for the undeniable proof that the work is finally complete. Now that we have established the initial boundaries of the battlefield, the trading range that forms after the uptrend has been decisively halted, we must transition from the role of a strategist observing the grand campaign to that of a detective conducting a forensic investigation. The first two proofs confirm that the market has entered a state of equilibrium, a prolonged and consequential war between the great informed interests who are selling and the still optimistic public who continue to buy. The next stage of our analysis requires us to read the subtle signals and study the small skirmishes within the confines of this range, for it is here that the most astute observers can find the definitive proof of which side is slowly but surely winning this hidden war. The third definitive proof in our anatomical study is the accumulation of signs of weakness within the range. Long before the final catastrophic break to the downside, the market will present numerous subtle clues that the forces of supply are beginning to gain a decisive upper hand over the forces of demand. These are the internal hemorrhages, the hairline fractures in the market structure that are invisible to the amateur who sees only a sideways market, but are glaringly obvious to the trained Wyckoffian analyst. The most powerful and intellectually elegant of these internal signals is the divergence between effort and result. This is a core principle of the Wyckoff method, a universal law that states that a healthy price move requires the harmony of effort, as measured by volume, and result, as measured by the extent of the price movement. When this harmony breaks down, it is one of the most reliable forms of proof that the underlying market dynamic is changing. During the distribution phase, we can observe this divergence with stark clarity during the rallies that punctuate the trading range. After an initial dip, the public, still conditioned by months of a bull market, sees an opportunity to buy the dip. Their renewed enthusiasm pushes the price back up toward the upper boundary of the range, and this buying generates a significant increase in volume. This surge in volume is the effort. The amateur trader sees this high volume on a rally and interprets it as a sign of strength, a confirmation that the uptrend is about to resume. But the professional analyst completes the equation by examining the result. He observes that despite this tremendous expenditure of buying energy, the price struggles to make upward progress. The daily price spreads may become narrow and labored. The rally may stall out and fail to even reach the previous high of the buying climax. In its most damning form, the stock may push slightly higher on a massive volume surge, only to close the day with minimal net gain, the price having been beaten back down by an invisible force. This is the definitive proof of distribution in action. The great effort is failing to produce a significant result because it is being met by a wall of silent, persistent, and overwhelming supply from the composite operator. He is calmly and methodically feeding his shares into the public's waves of optimistic buying. This inharmonious relationship is the market's own confession that the demand is being absorbed and that the stock is now too heavy with supply to advance any further. This concept is further confirmed by a clear structural change within the trading range, the appearance of lower highs. In the initial stages of a distribution top, the rallies may be strong enough to carry the price all the way back up to the level of the buying climax. However, as the composite operator continues to distribute his shares, and as the purchasing power of the public is gradually exhausted, each subsequent rally becomes weaker than the last. The second rally may fall just short of the first. The third rally may be even more feeble, reversing at a significantly lower point. This pattern of descending peaks is a clear and simple architectural proof that the buyers are losing their strength. Their ability to push the price upward is diminishing with each attempt. It is a visual representation of demand becoming exhausted. This series of lower highs forms a descending ceiling over the market, a structural barrier that proves that the sellers are in control, dictating the upper limits of any advance with increasing authority. Finally, we see the intermittent appearance of sharp, sudden signs of weakness. These are distinct downward price thrusts within the trading range that occur on a sudden spike in volume. While the composite operator will often step in to provide support near the bottom of the range in order to prolong the distribution process and prevent a premature panic, these sharp drops are significant and revealing events. They are moments when the supply being offered by the professional interests temporarily overwhelms the available demand from the public, causing a rapid air pocket in the price.